Okay, so next let's talk about tax prorations. Okay, we've talked about calculating the taxes sum, whether we're looking at a mill rate versus a per 100 rate, and we'll build on that a little bit more. But you have to understand when we're dealing with real property taxes, they are paid annually. And so no matter which state we're talking about, that's true. Now, from state to state, from municipality to municipality, that's where we get these variations in different rates. And of course, the way that taxes are handled also vary in the way that they're paid. So I want you to picture that a seller owns the property. And so in North Carolina, the seller owns the property through, whatever date and time they decide to sell it. And then, of course, the buyer's purchasing it. And so that means that somewhere in the midst of that year, there is an annual tax bill that has to be prorated. So prorating is just dividing the bill between the two parties. Well, there are a couple different scenarios depending on the time of year. It could be that the taxes will be paid later in the year by the buyer. And in that case, we have to make it fair for the buyer because the seller will have owned the property part of that time. And so it wouldn't be fair to charge the whole bill to the buyer. In some instances, towards the end of the year, the seller may have paid the full tax bill themselves. And that means that now we need to take money from the buyer and reimburse the seller some money. Or there is what we call a double debit scenario, which is where you could potentially be getting money from the seller and the buyer to pay the tax bill as part of the closing. Now, the differentiation is a little more in-depth conversation, just the proration, but I'm going to show you how to walk through some of these problems. Now, do be aware that on the pre-licensing test, you could see it prorated to what a 365-day calendar year, which is what we actually have. Or you could see a standardized testing proration of 360-day years. And in those instances, we also treat every month as having 30 days. It's just one of the things we do to standardize the test. It will clarify on the test which way it wants you to prorate. It will either say nothing and you're going to do it to the standardized 360, or it will clarify that for this specific problem, you were to do the 365-day standard calendar year proration. And so let me give you an example of what this might look like. If we were dealing with, let me just find some blank space here. If we were dealing with a $3,000 tax bill, and we were dealing with a 360-day year, and let's say that the buyer was purchasing the seller's house on March 7th. Okay, so we've got a little bit of information here. Now, in North Carolina, we don't consider our tax bill due and payable until September 1. Not all states consider it that way, so it's very important to read the question carefully to see, has the tax bill been paid yet? Has it not been paid? And kind of work accordingly. So in this instance, the way to think about this is like going out to eat with a friend. If I was to go out to eat with you and you were to order $700 worth of food and I was to order $300 worth of food, not to say that you ordered more than me or anything like that, but they bring the bill out and they combine these together and they just bring us a bill for $1,000. Well, we know this is how much you ate, this is how much I ate. And so when you go out to eat with a friend, what typically happens is you could potentially get separate checks, but in this case, they brought you one. So in theory, you could swipe your card for this full $1,000. And if I had the cash, I could just take $300 of my money and give it to you. And what that would do is kind of balance us out. Yeah, you swiped your card for $1,000, but because I gave you $300, you really only paid your portion. It's the exact same thing with taxes. Typically, one person will have to pay the tax bill either before closing happens or sometime after closing happens. And then we will get cash from the other party at closing to kind of make it fair. As I mentioned, there's the other alternative where, hey, we've got this $1,000 bill. You've got your $700 in cash that goes in. I got my $300 of cash that goes in. And we just pay the bill that way. And we don't have to worry about giving each other money because we just paid the bill in cash or in our appropriate portions. So let's go back to the question here. If we're dealing with a 360-day year, $3,000 tax bill closing on March 7th, the first step is to figure out how much somebody would owe per day, because we're going to be calculating how much you owe for a period of days. And so bring our calculator up. And so I'm going to set it right here. So of our $3,000 annual tax bill, divide that by 360 days, and that would tell us that you would owe, where did my calculator? There we go. It was kind of wonky there. $8.33 a day. Now this is what you would hear referred to as a per diem rate, or just per day. And so now you have to understand that the standard way that we look at this in North Carolina, and it's really, once again, going to come down to what the test question says. We give the seller the day of closing in North Carolina. So the seller owns the day of closing. So what that means is the seller owned the house in January, and understand under this 360-day year, that means every single month has 30 days. So January has 30. They owned it for all of February, which has 30. And then we're closing in March. And so they own up to and including the day of closing, which gives them 7 days in February. So the seller ate, in my analogy, 30 plus 30 plus 7 out of the entire year. And so if you take those, right, 30 plus 7 gives us our 67 days. And so we know how much somebody's responsible for per day. And so 67 times our per diem of $833 says that the seller's portion of that $3,000 tax bill is $558.11. Now, as I said, the tax bill isn't being paid typically in North Carolina until sometime after September 1. We'll talk more about that in the actual taxation section of the course. This is more focused on the math, but we need to figure out what this would look like on a closing disclosure. And so what happens is we take money from the seller and we give money to the buyer. Now, we don't use that terminology. When we're dealing with a closing disclosure or settlement statement, we use the term debits and credits. And I want you to think about it exactly like you would something that's in your wallet right now. If you swipe your debit card, money comes out of your checking account. It's gone. Somebody takes it from you. If you swipe a credit card, American Express, MasterCard, somebody gives you money to purchase that item now. Yes, you're going to have to pay it back later, but that's not really the point. Understand that a credit is giving you money and a debit is taking money from you. So if we're taking this money from the seller to give to the buyer, we would call this a $558.11 seller debit and a $558.11, let me move my calculator, buyer credit. Okay, now there's a couple different ways that we can do this. As I said, sometimes we'll be taking money from the buyer and giving it to the seller. Sometimes we'll be doing that double debit scenario. This is just a general understanding of how these tax prorations kind of work. Now I want to show you the way that this changes a little bit. Okay, I'm going to leave all of my dates and my numbers the same. I'm going to move my calculator and I'm going to get my eraser here. And I just want to show you that there is no real fundamental difference on the methodology between a 360 and a 365-day year. It's just the way that the per diem works out. So in that example, we did the fictitious pre-licensing 360-day year, 30-day month. Well, if the test question was to say something like, well, it is a standard calendar 365-day year. Now, you would still take that $3,000 tax bill, divide it by, instead of 360, 365 to figure out your per diem. Notice it changed ever so slightly. So now it's $822 a day. And so the days actually change a little bit too. So now if we're really treating it as an actual year, January has 31 days, February has 28 days, except on a leap year. Now, please understand the tests are never based on a leap year. So even as I'm recording this, it just so happens to be a leap year, but don't worry about leap years, okay? None of the testing is going to include leap years. In the real world, we would. And then in March, still just only giving them 7 days. So now the seller would be responsible for 31 plus 28 plus 7. So that's really the difference, what it comes down to between the 360-day year that we use in pre-licensing for standardized testing, But of course, as I said, you could see 365 in there as well. So now it is 66 days the seller's responsible for, times the per diem of 822, which would give us a $542.52 scenario. And so now this would be $542.52. Seller debit yet again, and a $542.52 buyer, move my calculator, credit. So, same methodology. Folks, the way that I like to teach math for the real estate licensing exam, you need to treat it like a hostage situation. Do what they tell you to do and no one gets hurt. Don't ever think you're smarter than the question. Don't ignore things in the question. If it tells you something crazy like the seller's responsible for the day of closing, that the buyer's responsible for the day of closing, which contradicts the default of the seller, do it anyway. There is no rhyme or reason to this math sometimes, and understand that math is a national concept, and sometimes you're studying for a state-specific exam where they may do something slightly different in that state, but because it's on the national side, just do what it tells you to do. So let's take a look at this actual workbook and practice a couple of these. So I'm going to move my calculator down here, and we're going to come back over here. This is where it kind of talks about prorations and gives a similar explanation to what I just gave you. So let's take a look at some example problems here. And so let's start right here, okay? Property is assessed at $160,000, and let me see if I can get it up here so I can do it better. Here we go. Property is assessed at $160,000 and is closing February 15th with a tax rate of $110 per 100. How will taxes be handled at closing? Now, folks, remember this is a per 100 rate. So when you read this, you don't go nuts here. You owe $1.10 per $100 worth of assessed value. So there's just the one tax rate. So let's remind you, first steps first, find the tax bill. Okay. I told you, personally, I like to convert my per 100 rate. My mill rate's always to a per dollar rate. I think it's just a lot cleaner for math purposes. But there's more than one way to do this, as I said. So we've got our $1.10 per 100 rate. Remember, 100 goes into itself one time. So when I take this per 100 rate and divide it by 100, I'm converting it to a per dollar rate. So now it's the same. It's just what we're saying is you would owe 0.011 cents per dollar of assessed value. So you take that and multiply it by your assessed value of $160,000. And so that gives us a tax bill of $1,760. But that's not the answer. The answer is how this be handled at closing. So without any information to the contrary, it's closing early in the year. Let's default to saying the tax bill can't be paid yet. Because in North Carolina, it can't be paid and technically not due and payable till September 1st. But case-by-case basis by state. So now we need to figure out whose portion is what. So let's do it based on our 360-day scale, because that is what the this packet is designed to do. So 360 days. So you take your annual tax bill of $1,760, divide it by 360 days, which gives us a, let me scroll over here. There we go. Per diem of $489 a day. And then the seller is responsible for all of January, which on our 360-day scale has 30 days. And then the 15 days from the 1st of February to the day of closing in February. And that is a total of 45 days. So then we've got our 489 times our 45 days equals $220. Now, folks, it's not enough to just say $220.05. What is typically going to be asked of you is to articulate who's the money coming from, who's the money going to. So in this case, it is a $220.05 seller debit, taking money from the seller, $220.05 buyer credit. There's your answer. I'm going to leave some of this other stuff up here, but I'll take away some of the extra that's in the way. And so we'll just put, maybe we'll just add back in 45 days. There we go. So let's take a look at the next one. Okay, property is assessed for $350,000 and is closing on December 15th. Taxes have already been paid with a tax rate of 75 cents per 100. How will they be handled at closing? So here's what I mean. It is closing towards the end of the year, but it means the seller has already paid the taxes. And so what really typically happens is the seller has an escrow account that I've mentioned in previous videos that the bank is holding their money. And so the escrow account has probably already paid this on behalf of the seller. Now, when the seller paid those taxes, at whatever point they paid them at, they're paying for the entire year. Well, they're not living there the entire year. Now, remember, the seller owns the day of closing, unless we say otherwise, for taxes, rents, and HOA dues. And so really and truthfully, you can think of it this way. The seller is responsible for the tax bill that includes the days from January 1st all the way up to and including December 15th. Now, regardless of whether we're doing the 360-day scale or the 365 days, it's still a lot of counting if you do it that route. So my recommendation is to use the path of least resistance. So first things first, let's calculate the tax bill, and then I'll show you what I mean. Property is assessed for $350, 75 per 100. So let's go 0.75, 75 cents per $100 worth of value. And I want to divide it by 100, like I've been doing, which converts it to a per dollar rate. So now we owe 0.0075 cents per dollar of assessed value. So multiply that by our assessed value of $350,000, which gives us an annual tax bill of $2,625. And so same steps as before. 360-day scale is what we're going to do. Let me make this just a little bit bigger. There we go. So let's take our 2,625, divide it by our 360 to get our per diem of 7.29. Okay. And then path of least resistance. Let me show you what I mean by this. And I might help if I make this even a little bit bigger for the next one. There we go. As opposed to counting January 1st all the way up to and including December 15th, folks, if we're doing a 360-day scale, that means December has 30 days in it. Okay, every month has 30 when we're doing a 360-day setup. So of the 30 days in December, the seller is responsible for the first up through and including the day of closing, which is December 15th. So subtract that out. That means that leaves us with 15 days in December for the buyer. So the buyer is responsible for 15 days. 15 days times the per diem of $7.29 a day. Oops. 7.29 a day. Gives us $109.35 that the buyer is responsible for. Now here's where you remember. The seller has already paid the full tax bill. So it's not that we're taking money from the buyer to pay the tax bill. The tax bill is paid. We're making it even, right? We're trying to balance it out. Think about that analogy of going out to eat with your friend. The seller's your friend. They swipe their card for the full bill. So you need to give them cash for what you ate to make it fair. And so this would be a 109.35 seller credit and a 109.35 buyer debit. Okay, debit means we're taking money, credit means we're giving money. Okay, very specific there. Let me slide this over. Let's see if I can try to grab this and move it. Nope. So that is the answer here. So the next one here So closing is set for October 30th. Taxes will be paid at closing for a property in the county assessed at $65,000. City tax rate is 35 cents per 100 and the county tax rate is 70 cents per 100. How will taxes be handled at closing? Now folks, you got to read the question carefully, okay? This will be dealing with a property in the county. And so that is in there to trick you by giving you the city tax rate, folks. It says nothing about it being in the city limits. And so now I told you, you always have to pay county taxes. But in this particular instance, because it is not located in the city limits, you have to know to ignore the city tax rate. If you add that in there, you will get the question wrong. We will very often put additional information, especially in math questions, for you to realize that you have to ignore it. That's part of the testing, if you will. So the only rate you're going to focus on is this 70 cents per 100. Okay? So 70 cents per 100 divided by 100 converts it to a per dollar rate. Take your 0.007 cents per dollar and multiply it by your assessed value of $65,000. That gives us an annual tax bill of $650. Okay, so we're going to put that. Okay, tax bill. Let's go back to black. Tax bill of $650. So the question is, how will this be handled at closing? Taxes will be paid at closing. This is that double debit scenario. Nobody has swiped their card. Nobody's paid the taxes yet. So what we're going to do is we're going to figure out both portions and we're going to debit from both parties. It's called a double debit. We're taking money from the seller, taking money from the buyer, and then the attorney will take this money, hold it in escrow, and they will pay the tax bill at closing. So then it's just dunsies. This isn't that food analogy of going out to eat that you put cash in the book for yours, I put cash in the book for mine, and then we just pay it, right? We just pay it. We don't have to worry about giving each other money. So $650. Yet again, I'm going to go the path of least resistance here. So as a buyer, you're responsible for everything after October 30th. Well, if we're doing a 360-day year, that means you're really just responsible for November and December. November and December, 30 days in each month, 60 days, okay? So it is 60 days for the buyer. And so if we take our $650 tax bill divided by 360, that gives us our per diem of 1.81 a day. Then we take our 1.81 a day times our 60 days for the buyer. Buyer is responsible for, we're going to write it right here, buyer debit of 108.60. Now folks, do not give yourself extra work. This full tax bill has to be paid. So as opposed to calculating, January, February, March, April, May, June, all the way through, and then calculating the days of the per diem, understanding that full $650 has to be paid, well, we know what the buyer's portion is. It's this number right here, 108.60. So take your full tax bill of $650 and subtract out your 108.60, because basically the seller's is whatever's left. So it's a buyer debit of 108.60 and a seller debit of $541.40 to pay the full tax bill. That's the answer. This is a double debit scenario. There we go. So there is a work through on some of the tax proration problems. Hopefully you'll be able to get through the rest of them after watching this video. The best way to get better at these math, folks, is just to practice it. The more you do it, the more you're exposed to it, the more you try it out, the better you will be. So stay tuned for more videos in the future. We're happy to help any way we can. Good luck.